Welcome back. I'm your host Tom Bruni and you're watching another edition of What the FICC, the weekly show where we discuss the most important chart or theme from the fixed income, commodity, or currency space. In last week's episode, we discussed the potential long-term trend change that's underway in the agricultural commodity space, as well as the variety of vehicles market participants have at their disposal to take advantage of that theme. If you missed that video and want to catch up, you can click right here. Otherwise, let's jump right into this week's topic, lumber. Now, if you did a survey of market participants and asked them what the best performing asset of 2020 has been so far, you'll get a variety of answers. A lot of them including technology stocks, maybe the Shanghai Composite or Taiwan that's outperformed internationally, and even precious metals, which have been ripping to the upside. But I think they'd all be surprised to know that lumber is at the top of that list, up 80% year to date, and it's more than tripled off of its March lows. That brings us to this week's topic. I want to focus on where lumber's been, how it got here, and where it could potentially be headed. So with that in mind, let's get into our first chart, a daily chart, looking back about 2 years at lumber prices. Now, what we can see here is prices have been holding above support throughout 2019 at the 297 level. But in March 2020, along with a lot of other cyclical assets, prices broke below support before quickly reversing back above it. This formed what us technicians call a failed move, which often leads to fast moves in the opposite direction. And boy did we get one this time. Now I don't want to get too deep into the psychology of why these failed moves happen, but it's just important to know that they exist throughout asset classes, not just lumber and commodities, stocks, bonds, currencies, you name it. We see this pattern both on the upside and the downside all the time. And what causes this pattern to lead to such explosive moves, you might be wondering? Well, it really comes down to positioning and market psychology. We've written a lot about it on the blog, so we'll link some down below as well as right here so that you can read all about it. Here we've got a 30-year chart of lumber using monthly candlesticks. And by doing this, we can really focus on the long-term trend. And what we're seeing is that prices just recently broke out of this massive 30-year base to new all-time highs. In other words, prices could collapse by 40 to 50% and still be above that initial breakout level, meaning the trend would still be intact. There's not many things that you can say that for. Now, it's unlikely that this type of explosive move can continue on forever. And while we're not trying to pick a top here, we're just trying to understand when prices do start to reverse, how do they typically play out through history? And what I did here was look at the 13-week rate of change going back to the 1970s. We have about 50 years worth of data. And recently, prices have their highest reading ever, up about 125% over the last 13 weeks. And what I wanted to identify was how do prices react when they start to move to the downside? Do these types of trends typically consolidate through time, or are they correcting aggressively through price, falling just as fast as they went higher? Let's take a look at the stats. Basically what I did here is I put together a table and I looked at the forward returns over a 1 week, 4 week, 13 week, 26 week, and 52 week period. Essentially looking at all major time frames, 1 week, 1 month, 1 quarter, 1/2 of 1 year, and a full year. And I wanted to see what the returns are for all data points that we have, as well as for those when the rate of change enters a 90th, 95th, and 99th percentile. So essentially what I'm trying to look at is how are the returns going forward after we get an extreme momentum reading like the one we just got. And as we can see from the table, extreme momentum readings actually lead to weaker forward returns over all of the time frames that we looked at. And as you get further down the percentile ranking from 90th to 95th to 99th, returns get much worse. All right, we've covered a lot of ground here, so let's quickly review. First off, the historic rally off the March lows in lumber was helped sparked by a failed breakdown, much like the failed moves we saw in a lot of other asset classes in March. Second thing we want to note is that although lumber is extended in the near term, it is still in a long-term uptrend as long as prices are above 460. That is the level at which this 30-year base breakout confirmed, and as long as we're above that level, this uptrend is now intact. With that being said, looking at historical data going back to the 1970s, we've concluded that massive rate of change increases like we've got over the last quarter are likely associated with lower forward returns. In other words, we would expect lumber to continue to struggle over the coming weeks, months, quarters, and potentially years as it works off this massive move that it's had over the last 6 to 12 months. Alright guys, that's all we've got for you today. If you enjoyed this video, make sure to leave a comment down below with your thoughts. We'd love to hear from you. And while you're down there, why not drop us a like and hit that subscribe button. That way you don't miss any more video updates from myself and the rest of the team here at All Star Charts. Thanks again for watching, and I'll see you guys back here next week for another edition of What the FICC.